Stop what you're doing. No, seriously, stop. Put the coffee down. Pause the podcast. Tell your dog you'll explain this later. Because while you were sleeping peacefully, someone quietly pulled 2.9 million ounces of silver out of the system, and the market noticed immediately. What you are about to hear will blow your mind. Let's rewind to what actually happened while you were asleep. It has officially begun. The event that we have been tracking for 3 years, the event that marks the mathematical end of the price suppression regime, just occurred in the dead of night while the Western world was asleep. If you were looking at the spot price of silver this morning and thinking it's just another day of volatility, you are missing the most critical signal in the history of the COMEX. Trading didn't just volatile, trading broke. At exactly 3:45 a.m. Eastern Standard Time, during the thin liquidity of the Asian-European overlap, a massive air pocket hit the silver futures market. And we witnessed a sudden violent cessation of liquidity followed by a vertical price reaction. But the price movement is just the symptom. The disease is what happened in the vault. We have received confirmation from the overnight delivery reports that a staggering 2.9 million ounces of silver were abruptly reclassified and pulled from the registered category. To put this into perspective, 2.9 million ounces is not a rounding error. It is not a standard commercial rebalancing. That is roughly 90 metric tons of strategic metal. It is the equivalent of the entire monthly production of a primary silver mine, like the Cannington mine in Australia, vanished in a single keystroke. But here is why this specific withdrawal is the kill shot for the banks. It happened after the price began to rise. Usually, when the price spikes, inventory flows into the exchange to capture the profit. This is basic economics. High prices attract supply. But last night, the price spiked, and the supply fled. The metal ran for the exits. This is a phenomenon known as backwardation on a systemic scale. The market is screaming that it does not trust the future promise of delivery. The entities holding that silver, likely sovereign wealth funds or major industrial conglomerates, looked at the rising price and said, I don't want the cash, I don't want the contract, I want the metal, and I want it now. This 2.9 million ounce withdrawal has effectively snapped the liquidity bridge that the bullion banks use to manage the price. You have to understand that the banks operate on a fractional reserve system. They sell hundreds of paper claims for every 1 ounce of physical silver in the vault. They rely on the fact that nobody ever asks for the real stuff. Well, last night, someone asked. And they didn't ask for a few coins. They asked for a mountain of silver. The reaction was immediate. The algorithms that control the paper market froze. We saw a bidless moment where the machine could not find a seller to match the buy orders. This is why trading broke. The suppression algorithm relies on liquidity to function. When the physical metal disappears, the leverage becomes a noose. We are now staring at a commercial signal failure. The mechanism that has kept silver below $30, below $50, below $100 for decades is dissolving before our eyes. The 2.9 million ounce withdrawal is the first domino in a chain reaction that ends with the total depletion of the COMEX vaults. The silence from the mainstream financial press is deafening. They are talking about interest rates. They are talking about tech stocks. They are ignoring the fact that the strategic supply of the most conductive metal on Earth just experienced a bank run. This is not a drill. The smart money has pulled the plug. They are taking their chips off the table. If you are holding paper silver, you are holding a claim on a vault that is being drained by the hour. The 2.9 million ounces are gone. They are never coming back. And the run has only just begun. To understand why 2.9 million ounces vanished overnight, we have to look away from New York and stare directly into the abyss of the geopolitical reality. We have to talk about the Shanghai vacuum. The Western financial system likes to pretend that New York and London are the center of the universe. For 40 years, they set the price. But the center of gravity has shifted. The 2.9 million ounce withdrawal was not a random event. It was a targeted extraction operation driven by the arbitrage gap. We have been tracking a massive anomaly between the Shanghai Gold Exchange, SGE, and the COMEX. Right now, silver is trading at a premium in Shanghai that converts to roughly 15% higher than the price in New York. Think about the physics of that. If you can buy an ounce of silver in New York for 85 spazers and sell it in Shanghai for 98, what do? You buy everything. You drain the West to feed the East. This 2.9 million ounce pull was likely a risk-free trade, executed by a sophisticated player who realized the Western banks are asleep at the wheel. They bought the paper contracts, stood for immediate delivery, and are now shipping that metal to China to capture the spread. This is the Shanghai Express. It is a giant sucking sound that is depleting the strategic reserves of the United States and Europe. But it goes deeper than just profit. This is geopolitical warfare. China knows that silver is the Achilles heel of the American military-industrial complex. You cannot build a Tomahawk missile without silver. You cannot build a fighter jet without silver. You cannot build a satellite without silver. By allowing the price to remain high in Shanghai, China is incentivizing the world to send all available silver to their vaults. They are cornering the market not by force, but by price. The Western banks, JP Morgan, Citi, HSBC, are trapped in their own suppression scheme. They have spent decades keeping the price low to protect the dollar. Now, that low price is the very thing that is allowing China to buy up the entire global supply for pennies. The banks cannot stop the drain without letting the price rise. But if they let the price rise, their short positions blow up. It is a checkmate scenario. The 2.9 million ounce withdrawal proves that the registered inventory at the COMEX is a lie. The official numbers say there are 30 or 40 million ounces, but if that were true, a 2.9 million withdrawal wouldn't break the trading algorithm. The fact that the market reacted so violently tells us that the free float, the silver that is actually available to buy, is razor thin. We are likely down to the dregs of the vault. The good delivery bars are gone. What's left is dusty, encumbered, or leased out to 3 different people. This vault drain is irreversible. Once the metal crosses the ocean, it disappears into the state reserve of China. It does not come back. We are watching the deindustrialization of the West in real time, measured in ounces of silver. The U.S. Mint is already struggling to source planchets. The refineries are warning of delays. And now, 2.9 million ounces just left the building. The arbitrage gap is the mechanism of our destruction. As long as the West suppresses the price, the East will drain the vault. The only way to stop it is for the price in New York to match the price in Shanghai. And that means a vertical revaluation. The 2.9 million ounce signal is the warning siren. The vacuum is increasing power. The vault is emptying. Now we have to look at the mathematical consequence of this withdrawal on the paper market. We have to talk about the gamma trap and the risk of a limit up event. The bullion banks are not just short, they are short convexity. This means that as the price rises, their losses don't just grow linearly, they grow exponentially. They have sold millions of ounces worth of call options to speculators who are betting on higher prices. When 2.9 million ounces are pulled from the vault, it ignites a panic in the futures market. Traders realize the physical backing is gone, so they bid up the price of the paper contracts. This pushes the price toward the strike price of the options the banks sold. When the price hits that strike zone, let us say $90 or $95, the banks are forced to hedge. They have to buy futures contracts to cover their exposure. But remember, the inventory is gone. So they are trying to buy futures contracts in a market where the physical metal backing those contracts has just been loaded onto a truck. This creates a gamma squeeze. The banks buy to hedge. Their buying drives the price up. The higher price puts more options in the money. So they have to buy more to hedge. It is a doom loop, a feedback loop of forced buying. Usually, the banks stop this by spoofing or smashing the price with a massive sell order. But they can't smash the price if the metal is leaving the vault. The physical market is calling the bluff of the paper market. If they try to sell 5,000 contracts to cap the price, a whale will just step in and say, "Okay, I'll take delivery of those too." They are out of ammo. This leads us to the limit up risk. The exchange has rules. If the price moves too fast, they halt trading. We are approaching a scenario where the silver market opens, hits the daily limit up, and stays there for days. Imagine waking up and seeing silver at $100, but you can't buy it because the market is halted. Imagine being a short seller trapped in that trade. You can't get out. You just watch your account balance go negative. The 2.9 million ounce withdrawal is the catalyst for this squeeze. It removed the buffer. It removed the shock absorber. Now it is metal on metal. The open interest in silver futures is astronomical compared to the registered inventory. The ratio is likely 400 to 1. For every ounce in the vault, there are 400 paper claims. When 2.9 million ounces leave, the leverage ratio spikes even higher. It becomes a mathematical impossibility. The algorithm knows this. That's why trading broke overnight. The computer models couldn't calculate a fair price because the inputs, inventory versus demand, were returning an error message. The error message is default. The banks are staring at a default event. They are naked short in a rising market with disappearing inventory. The gamma wall is not a barrier anymore. It is the fuel for the rocket. When this squeeze truly ignites, it won't be a steady climb. It will be a teleportation. While the bankers are hyperventilating over their gamma exposure, the real panic, the visceral survival level panic, is happening in the industrial supply chain. The 2.9 million ounce withdrawal wasn't just noticed by traders, it was noticed by the procurement officers at Samsung, Tesla, and the solar giants. We need to talk about the solar coffin. This is the term we use for the trap the green energy industry has built for itself. They have committed trillions of dollars to a transition that requires massive amounts of silver. The new TOPCon solar panels use 50% more silver than the old technology. The new solid-state batteries for EVs use silver carbon inputs. There is no substitute. Silver is the most conductive metal in the universe. You cannot use copper, it is not efficient enough. You cannot use gold, it is too expensive. It has to be silver. When a company like Longe Solar, the world's largest panel maker, sees 2.9 million ounces vanish overnight, they don't see a chart pattern. They see a supply chain fracture. They realize that the just-in-time delivery model they have used for 30 years is dead. They realize that if they don't secure metal today, their factories stop tomorrow. This triggers the shift to just-in-case hoarding. We are seeing reports of massive off-market deals. Industrial giants are bypassing the COMEX entirely. They are flying directly to Mexico and Peru. They are walking into the mine offices with briefcases full of cash and saying, "We will buy your entire production for 2026. We will pay a premium. Just guarantee the delivery." This is the shadow drain. It removes the supply from the public market before it even gets there. The 2.9 million ounce withdrawal from the COMEX is just the tip of the iceberg. The real drain is happening at the mine head. The COMEX is becoming a market of last resort. Industry only goes there when they can't get metal anywhere else, and now even the COMEX is being emptied. The demand for silver is price inelastic. I cannot stress this enough. If the price of silver goes from $30 to $100, does Tesla stop making cars? No. Does the US government stop building missiles? No. Does the solar industry pack up and go home? No. They pay the price. Silver is a tiny fraction of the total cost of the final product, but it is essential. This gives silver infinite pricing power. The industrial buyer must buy at the market price. They have no choice. So, when the banks try to short the market to suppress the price, they are fighting against an enemy that must buy. Who wins? The entity that needs the metal to survive, or the entity that is just gambling on paper? The 2.9 million ounce withdrawal is the signal that industry has stopped trusting the banks. They are taking possession. The solar coffin is slamming shut on the shorts. The industrial users are nailing the lid down. Now we arrive at the consequences for you, the individual stacker. The 2.9 million ounce withdrawal has triggered the onset of the unobtainium phase. We have warned you that a day would come when the price on the screen becomes a lie. That day is here. The spot price might say $85 or $90, but try to buy a monster box of Silver Eagles right now. Go to the major dealer websites. What do you see? Notify me when available. Pre-order, expected delivery 12 weeks. Limit 1 per household. This is the retail lockout. The dealers are the canary in the coal mine. They operate on thin margins. They cannot afford to sell you silver at $90 if the replacement cost is $95. When they see 2.9 million ounces leave the COMEX, they know that the wholesale supply is drying up. So they execute defensive pricing. They jack up the premiums. We are seeing premiums of $15, $20, even $25 over spot for sovereign coins. This means the street price has completely decoupled from the paper price. If you're waiting for the spot price to dip so you can buy cheaper, you are hallucinating. The spot price is a ghost. It is a fiction maintained by high-frequency trading algorithms. The street price is the reality, and the street price is going vertical. We are also seeing the return of the bid-only market. Local coin shops are turning into roach motels. Metal checks in, but it doesn't check out. Dealers are hoarding inventory. They will buy your silver if you are foolish enough to sell, but they won't sell any of their own stack. They know that cash is trash. They know that a wire transfer is just digital dust. They want the metal. This is the force majeure of the retail sector. You have the money, you have the desire, but you cannot acquire the asset. It is unobtainium. The 2.9 million ounce signal means the window is being bricked over. Those who hesitated are now trapped on the outside. They will be left holding depreciating fiat currency while the purchasing power of silver explodes. You cannot eat paper. You cannot build solar panels with paper, and you cannot preserve wealth with paper. The sold out sign is the defining image of this crisis. If you can find metal, buy it. Do not look at the premium. The premium is just the cost of admission to the lifeboat. In a year, you won't care if you paid $5 over spot or $20 over spot. You will just be glad you have the ounces. The 2.9 million ounce withdrawal was the firing of the starter pistol for the final run. The shelves are clearing. The panic is setting in. The endgame strategy, minor pivot and ratio. We have analyzed the breakdown. We have seen the vault drain. We have felt the industrial panic. Now we need a battle plan. How do we navigate the chaos triggered by this 2.9 million ounce pull? Strategy 1. Hold the physical line. Do not sell. I repeat, do not sell. When the price hits $100, the temptation will be massive. The media will call it a bubble. Your friends will tell you to cash out. Ignore them. We are not trading silver for more dollars. We are holding silver because the dollar is dying. $100 is not the top. $100 is the breakout. The destination is a complete repricing of the asset. We are looking for parity with real-world inflation. Hold your physical stack until the system resets. Strategy 2. The miner pivot, leverage. If the physical market is becoming unobtainium, the next best place for capital is the mining sector. The 2.9 million ounce withdrawal is the greatest bullish signal for miners in history. It guarantees higher prices. And for a miner, higher prices mean exponential profits. Let's do the math again because it is critical. Miner A has a cost of $20. At $30 silver, they make $10 profit. At $90 silver, they make $70 profit. The price of silver went up 3x. The profit of the miner went up 7x. This is operating leverage. But the mining stocks are still trading as if silver is $25. They are priced for bankruptcy, not for a boom. We are rotating capital into unhedged miners in safe jurisdictions. Canada, USA, Australia. We avoid miners who hedge their production, sold it forward, because they won't participate in the rally. This is where the 10x, 20x, 50x wealth generation happens. Strategy 3. The ratio play, the exit. We are watching the gold to silver ratio. This is our compass. Right now, the ratio is high. Silver is cheap relative to gold. The 2.9 million ounce squeeze will crash this ratio. Silver will outperform gold. We wait for the ratio to hit 30 to 1. We wait for 15 to 1. That is the signal. When silver is historically expensive compared to gold, we execute the swap. We trade the volatile industrial metal, silver, for the eternal monetary metal, gold. We lock in the purchasing power. We effectively triple our gold stack without spending a dime. This is how dynastic wealth is built. You ride the wild horse up the mountain and you take the carriage down. The conclusion: the 2.9 million ounce withdrawal overnight was not a glitch. It was the system breaking. It was the smart money leaving the casino. The banks are trapped. The industry is panicked. The retail is locked out. You are on the right side of the trade. The short squeeze has transitioned from a possibility to a mathematical certainty. The run has begun. Subscribe to the channel. Turn on the notifications. We are tracking the vault data hour by hour. We will tell you when the next withdrawal hits. We will tell you when the force majeure is declared. Hold the line. Class dismissed.